I said there, today's webinar is going to be recorded. My name is William Pierce. I know I'm not your guys' usual host for your webinars. You're used to seeing the always lovely and always wonderful Sadie Palmer on these. This is year 3 or 4 of us doing this tax webinar that we've done. It's always been a big hit and always been a request. So I am back to do it for another year for you guys. As I said, my name is Will Pierce. I am one of our key accounts specialists here at Senior Marketing Specialist. Been with the company a little over 6 years. A couple disclaimers as we go through this. I am not a CPA. I am not an accountant. Both of my parents do happen to be CPAs, and I have a weird enjoyment and a weird fascination for talking about all these things. My wife and I are both also small business owners, so these are things that we deal with on our own and in our yearly filings when we are working with our accountant on this. So with that being said, I am going to get us kicked off and get us started on today's 2024 tax tips for agents and for agencies as well. So first and foremost, what's the big deal? I know, when we're coming into it, that's kind of the first question that always comes to mind is, well, does it really matter? What really matters? And what is the big deal? Whenever I talk to people in the industry, I always make sure to remind them that, listen, the way you guys make your income is unique in the world of small businesses. Yes, you've got that upfront commission, and then you've got your yearly renewals that do compound on top of all of that. But it's the commission itself that makes it very different and makes it different from a tax standpoint when you're working on getting all those filings in. Your typical small business, you think of like a shoe store in your downtown area, they hold inventory. They have to order inventory, and they may have some more depreciating assets that they can write off during the actual tax filing portion. Insurance agents don't have, we don't have sales tax we have to account for. We don't have inventory in the same sense that your normal small business has to order, has to hold, accounts receivable, accounts payable, those normal things we kind of think about in an accounting structure, we don't have on a commission-driven income on like an insurance agent or like a realtor might have as well. So that truly does make your income and make your situation a little bit unique. And with that, you have some differentiating tax needs, and you need a little bit different of a process than your normal small business might. Now, something that not everybody thinks of or is always a good reminder is that your contracting is important to your taxes. And I say that from the standpoint of how you are contracted is going to, of course, dictate how you are going to be paid. When you're looking at setting up your contracting, are you going as an individual only? Are you going as a sole proprietorship or an LLC, a S Corp or a C Corp, or are you getting paid on a corporate tax basis, or are you getting paid on a pass-through tax basis? The last number I saw was actually a little over 90% of small businesses in the United States are paid on a pass-through tax basis. And just what that means is, you may be set up as a sole proprietorship, DBA, LLC, or something like that. But at the end of the day, the taxes are still reported to your social versus to your EIN. Those taxes pass through your EIN and are then reported to your social. Now, the reason that this can be important and that this matters is there were some small tweaks to the 2024 tax brackets for individual income. So those taxed on either directly to your social or on a pass-through basis through your entity. They were very small tweaks, just kind of reshuffling around where some of those brackets fall and what income numbers those brackets are tied to. But it's important to think about the future of your business as well. As you scale and as your business continues to grow, your income and your revenue hopefully also continues to grow. And so there may be a point where it may be worth talking to your accountant about a restructure of your tax classification and actually setting yourself up to be taxed on a different basis. I would make sure you're working with your accountant on that if you do have one, and just knowing kind of where that cutoff might be. It might be something that, your goal is never to be big enough to need to worry about that, or maybe your goal is to be big enough that could be a potential future concern. But the individual tax brackets for 2024 range from 10% all the way up to 37%. And kind of where that big difference is the corporate tax rate federally is a flat 21%. So depending upon where you fall and where your revenue is scaling to, it might be worth kind of looking at a restructure and looking at reclassifying that. Just make sure you are aware of what tax bracket you do fall into and kind of future goals for your agency as well. Like I said, if you don't ever think you're going to be big enough to need to worry about that, you can still make a very healthy income and a very healthy life as an independent insurance agent paid on a pass-through sole proprietorship or a pass-through LLC. If you are structured as an LLC, LLCs will give you the option to be paid on a pass-through tax entity or to be paid as a corporate. So that'll just depend on how you have that structured and how you have that set up. If you've not gone through and gotten set up as a corporation, there are a lot of benefits to it. Some of it we'll cover today. Some of it we will not have the chance to get to because it's not directly related to your taxes. It's related to other benefits of being set up as a corporation. So if you haven't contracted even as an LLC or a sole proprietorship, I always advise to do so as insurance agents. That's something that our contracting team and our sales team can help you walk through the process and walk through the full picture of your benefits of that. Now, next up is everybody's favorite thing to think about, and that's going to be your organization. You know, we think every day and in every way about keeping our clients' files in order, making sure our CRM is as up to date with as much information as possible, keeping it nice, spick and span, and making sure that if that client calls, you know right where their file is, you know exactly what they're going to need, and you know exactly what plan you're planning to put them on. Running your business and running your agency, it needs to be no different than that. Something that I tell everyone when it comes to working on their CRM or working on their taxes is that the data out is only going to be as good as the data in. If you're not inputting clean and concise data that matches up, your data out is going to be messy and it's going to be not nearly as useful to you. So making sure that you've got everything organized, whether you're using a filing cabinet with labels or if you use a digital system like something like QuickBooks or another accounting software, making sure that you have a system and a process for every single thing, because not only when time comes to actually file these taxes is it going to be easier and it's going to be faster, but if you're ever audited, you're going to need to have proof. You're going to need to have receipts on hand. You're going to need to submit the information that they're requesting. And I can promise you nobody wants to deal with the IRS. Nobody wants to have them hounding them for documents or getting letters in the mail constantly of, hey, we need this. You're going to owe X, Y, and Z and extra taxes. I don't ever want to get that letter. I know you guys don't ever want to get that letter. So please make sure you've got a process for your organization. You know, don't just have a stack of receipts on your desk next to you at the office of your marketing expenses for the year or your other things you're planning on writing off. Make sure you're putting those in a software and in a system. For our small business, we use QuickBooks here between myself and my wife. It is really easy. You sync it up to your business account, as I have mentioned here as well. You sync it up to that, and anything that goes in and out of that account, you can categorize it, and you can actually attach a copy of the receipt to that expense. So it makes it even easier when time comes, if you are ever audited or when you're submitting the information to file your taxes, you know, I spent $1,000 this year on my marketing expenses. I've got all the proof right here. There's my write-off for that, submitted right onto my return, and making everything nice and clean. Secondly, that people I think don't think about enough is going to be don't mix your funds. And what I say by that and what that means is have things separate. Have a business checking account, have a business credit card, have a business savings account, and then have your personal one as well, of course, whether they're at separate banks or you bank with your favorite local bank and your favorite local banker. Make sure those are separate and do not, as much as you can, commingle those funds. Commingling funds can get very messy if an audit is ever ran and they see that you're taking from your personal, moving it in and moving vice versa, and just kind of wish-washing those funds around. That's going to get messy if an audit ever does come, and it can open you up to other problems as well. So make sure you've got a separation of those funds. Pay yourself out of your LLC, whether it's a set salary or you pay yourself 50% of everything that comes into the agency from an income standpoint. Have some sort of structure in place for that so that you're not commingling those funds. It's very, very easy to commingle funds. So I would make sure you've got something separate there. Whatever your profit or payment strategy to yourself is, needs to fit your needs and needs to fit your business, but have a consistent method in place. And I know that's really hard if you're a newer agent into the industry and trying to just get everything up off the ground and get everything running. You're going to feel like you're eating ramen noodles every single day, 5 days a week for 365 days a year. It can be hard to get started out, but you want to make sure you have those protections in place to not commingle those funds. So have a business account, have a business credit card as well. A lot of business credit cards that are out there have some really good reward systems and point systems to them as well. I would take a look at that. I've talked to some business owners that like to use the Spark card. Some agencies swear by Amex cards. It all kind of depends on your needs, and your local bank may have really good business credit card options as well for you that may not be a national company or national chain. I would definitely talk to them as well if that's where you have your business accounts through. It's not on here, but something else to keep in mind when you're keeping your meticulous records is think about how you're going to pay your taxes. We know as 1099 producers here that we don't have taxes taken out before we get paid. Everything comes to us on a pre-tax basis. Our Social Security, our Medicare, income tax, that's not all automatically withheld. One thing that I do really like about QuickBooks is it will give you an estimate of your taxes due based on the income that's come in. So it's a really easy way to make that a little less stressful, figuring out what am I going to owe in taxes. There's a couple additional ways that you can also make that a little less stressful and kind of take the worry and the concern out of it. You can use the IRS form 1040-ES to actually look at that and kind of come up with a bit of an estimate if you're not using an online system, or if you don't have an accountant that you already work with. You can use that 1040-ES form to figure out an estimated tax owed, or like I said, you can use a tracking software or an accountant to help you with that as well. And then there's kind of a couple different schools of thoughts on how to manage your taxes owed. You can take, I've talked to some agents that just take 10% of what comes in, put it into a savings account, and then don't touch it throughout the year, and kind of use that as a cushion to pay for that tax owed. Or they take 20% or whatever their number they feel like needs to be, so that they at least have some money they can liquid at that time, is going to be what's going to work best for you. You can also pay quarterly estimates throughout the year. This can be a really easy way to kind of ease that burden at the end of the year. You're paying it in chunks as the year goes. We know in this industry, income can be very cyclical. If you're writing a lot more during your AEPs, your income is going to be a little bit more cyclical than, if you're writing year-round med subs that hit their renewals at different times throughout the year. All those kinds of things do come into play, but quarterly taxes really and truly can reduce the burden of a lump sum payment at the end of the year. Nobody likes seeing that dollar figure after a really successful year of, hey, this is what you owe the government too, by the way. Hope you didn't forget about us. Nobody wants that. And so those quarterly estimates or just taking a percentage and putting it into a business savings account or something like that, a way to kind of shelter that so you're not spending it and not putting that money out as well. There are a couple instances in which you could potentially be charged an underpayment penalty if you don't do enough on your estimates, or if you come in well under. There's also a few instances in which they will not charge that underpayment penalty if you pay at least 90% of the tax you owe for the current year, or 100% of the tax owed for the previous year, or if you owe less than $1,000 in tax after subtracting withholdings and credits. I would talk to your accountant, if you haven't, about where the safe harbor rule kind of comes in as well. Safe harbor rule is a little altered for people above certain AGIs or adjusted gross income thresholds. I would speak with whoever your financial advisor, planner, or accountant is on that and make sure that if you are doing estimates, that you're not going to come in and potentially get an underpayment penalty. So to recap this slide and what's important on it, be organized, have a system in place. You've got a system in place for client intake, client record retention, and all of that. Your taxes and your money in your business needs to be no different on keeping that organization and keeping everything in a system, whether you use paper or digital, whatever works for you. I recommend digital. Cloud storage is a heck of a lot cheaper than buying another really, really big filing cabinet to stuff everything into. And we're going to talk later on about why being fully paper reliant might not be the best long term and at the end of the day for your business. Don't mix your funds. Please try not to when you're going through. Make sure you've got a method in place for how you pay yourself and how you account for your expenses as well. And then have a business account. I recommend everybody, if you're full-time running your agency, running a business, have a business checking, savings, and a business credit card. At least one of each for those. You could have a business credit card for just your marketing, for other things. You know, you can allocate that however you want, but I truly do recommend at least one of all of those categories. This is everybody's favorite slide. Listen, everybody loves a good deduction, myself included. My accountant loves when I come to him with deductions. It's so much better, and this is why keeping those meticulous records is extremely important, is because you got to make sure you can maximize your deductions. The benefit of a deduction is that then lowers your taxable threshold. So the more deductions and the more reasonable and real deductions you can come up with, the better that's going to look at the end of it. The terminology I always use and always hear in the industry is usual and customary or reasonable and customary. It's got to make sense for your business. If you, as an insurance agent, bought, you know, a full set of thesauruses to keep in your office because you think they look really good in your bookcase, I could argue that that's not a deduction, that's not a write-off, just because you think it looks really good in your office. But if you go out and you buy yourself a new laptop or a new pair of noise-canceling headphones to use just for work and just for client appointments, that you can make a case for and you can submit as a reasonable and as a deduction that does make sense. I'm going to go through some of the four most common ones, and then another one that I'll talk about that's not on the slide, but depending on the size of your business as well, this one could come into fold too. But marketing expenses, super straightforward. You know, I think that one makes the most sense. What you spend on your marketing is going to be tax deductible. So if you are sponsoring a table at the local county fair and you've got, you know, your giveaway pins with your information on them, stress balls, fidget spinners, whatever you've got and whatever you've paid for to be branded to have as marketing expense is going to go under those deductions. If you're working on, you know, building out an online lead generating platform that is branded for your agency and is going to bring in business for you, there's a marketing expense. Mileage gets a lot of confusion and probably doesn't get tracked well enough by a lot of agents, if I had to imagine. Mileage you can deduct to and from client homes to your office. So if you're driving to your office because a client either can't come in or doesn't want to meet virtually with you over a video call or over the phone, you have to drive to them from your office. That trip to and from your office to their home and back can be deducted. Now there's a couple different softwares out there. You can either manually track it on, you know, pen, paper, notepad. If you want to write that out, you know, was that 1,056 miles before the trip, then 1,072 when you got back from that client's home and from that appointment. You can track it manually. There's also a lot of apps out there now that will actually do it for you. When you pull the app up, obviously we'll ask for location permission because it's going to need it because it uses a GPS to map how far that route was back and forth. I think Mile IQ is one of them that I've heard a lot of people talk about and recommend. As you pretty much, it's on your phone, drive with you wherever you go. You start the trip and end the trip, and it automatically maps and automatically tracks that for you. There is a certain amount, like per mile, that can come back out to, and it changes a little bit year to year. So I would talk with your accountant on your 2023 tax year filings, make sure if you have kept records of your mileage when you drive to the office and to the client's home and back, that you are deducting those when and where you can. Like I mentioned, and like I hinted at a little bit earlier, computers. We all know that a good laptop and a good computer isn't going to last forever. Eventually, it's either going to run out of room for updates, or it's just going to not have the capability that you need anymore. Maybe you need a full desktop setup. Maybe that laptop just isn't cutting it for you anymore. If you need to make that purchase and you need to make that expense, that is deductible. Great time to keep your receipt as well. If you go buy it from Best Buy or Target or an online store, keep that receipt and keep it in a safe and secure place that you can deduct it. And then is any business insurance as well can also be deducted, whether that's, you know, your policy on your building or, you know, anything like that can be deducted. So make sure you're keeping records of everything you pay and all the policies that you have as well. And two more I don't have on the slide, but that I do always like to talk about, classes and workshops. This can include some of your continued education and or other things that you attend that you pay for. Now, kind of the caveat that the IRS puts within that is always that they need to add value to the business and help you maintain necessary skills. If the course that you're attending isn't adding value to your business and or helping you maintain a necessary skill, you might not be able to write that off. But if it is, if it's a CE course, or maybe you're looking to get into annuities this year, and so you're paying for that continuing education for the annuity suitability and fundamentals 4-hour CE course, that can go towards write-offs because that adds value to your business and helps you maintain your necessary skills to do what you do. And the last one that you might run into depending on the size and the scope of your business, but it's going to be health insurance for your employees. That can be a pretty big deduction at the end of the year when you get that all set in stone and all done. So if you are offering health insurance to your employees as an employer, make sure you're keeping record of all of that. If you have a small group agent that has helped to write that policy, if you get all the forms from them towards the end of the year and take that to your accountant. All right, retirement planning. I don't know about you guys. I don't want to work forever. I don't want to work till the day that I die. I would like to retire at some point. So there's a couple different options that you guys will have as independent business owners and as 1099 employees that really are some of the basics. I'm actually going to work this one from right side of the screen to left. And the reason I do that is because I kind of hinted at this last one early in it, but if you are ever thinking that, you know, my retirement is actually just going to be to sell my agency, sell my renewals, and take that and sail off into the sunset with it, that's awesome and that's wonderful. Being set up as a corporate and as an LLC can actually make that a lot easier and a lot smoother of a transition. Not only that, but if you have kept paper files, that actually can be a lot harder of a transition than if you have kept everything digitized. So that is why I recommend digital files when you are getting everything set up, doing it as early as you can in the process. If you're 5-10 years in now, I know it's going to be a bear and a pain, but make the transition if you do plan to sell your agency as part of your retirement package. And then next up, we've got the Simple IRA. Now, what the Simple IRA stands for is Savings Incentive Match Plan for Employees. It allows employees and employers to contribute to traditional IRAs that are set up for your employees. It's really kind of ideally set up for startup retirement savings for small business employers that are not currently sponsoring a retirement plan. Some of the quick pros and cons of it is that it is easy and relatively inexpensive to set up and to operate. Employees do share a responsibility for committing to their retirement. So you as the agency owner are not committing every penny into their retirement. They are also, you know, responsible and able to make their own commitments as well. It does not have any discrimination testing required. However, it can be a little inflexible on those contribution amounts. I would talk to a financial advisor and a financial planner if you are thinking of going either with an SEP IRA or a STEP, as they're sometimes called, or a simple as well. The simple IRA does also have some lower contribution limits than maybe some of the other options out there. Now, one of the other common ones that we see is the SEP, also known as the Simplified Employee Pension Retirement Plan. It can provide a really significant source of income at retirement by allowing the employers to set aside money for both themselves and for their employees. Now, some of the quick pros and cons, it is also very easy to set up and operate. It's got pretty low administrative costs, and it does have very flexible annual contributions to that plan. If maybe cash flow might be a bit of an issue, if maybe you're a couple of years in, cash flow isn't super heavy right now, but it plans to be in the future, SEP IRA might make sense for you. Now, kind of here's where the SEP kind of maybe takes a step back and or maybe is a little different from the simple IRA. You must contribute equally for all eligible employees. Now, what that means is if you want to put in 20% for yourself, all the other eligible employees at your company also need to have that matched. So you've got to put 20% in for everybody then. Can't put in a bunch for yourself and then not match that for your employees as well on a SEP IRA. So that's going to really depend on what's going to work best for you and what you want to do. I would talk to a financial planner if you are looking at setting one up for your company, for your agency. If you haven't yet, please talk to a financial advisor for that and make sure you know which is going to be the best path for you. And the last main slide that we've got, I recommend everybody consult with a professional. I don't just say that because my parents are CPAs and it's great for job security. I truly do recommend it, and I truly do mean it as a small business owner myself and someone who works with 1099 brokers every single day here at SMS. Tax regulations are always changing. You guys have enough on your plate to keep up with the CMS regulations and the carrier rules that are always evolving, and you're always having to make shifts, changes, new platform, different signature process, call recordings, scope of appointment rules. There's so much that you guys have to keep track of already. I would not want to have to try to keep up with the IRS on top of all of that, plus manage your clients. CPAs are always up to date on the tax code. They are always up to date on what has changed and how it's going to impact you. Tax regulations are always in flux. I don't want to have to try to keep track of that, and I would advise you guys to not try to as well. And then last one, I know it's kind of humorous, but I don't want to talk to the IRS. You probably don't want to either. I don't know if you've had to call them recently, but it is not fun, long hold times, never pleasurable to work with the IRS and have to talk with them if there's an issue. Your CPA and your accountant can handle that for you. A small benefit as well that they have that we don't is they usually get dedicated lines that they can actually call and get quicker access right to people. Non-CPAs, non-financial planners don't have access to these phone lines. They are special just for people in the tax industry that gets them an answer quicker. If you're a small business owner, you've probably gotten gobs of letters and stacks of letters from the IRS with jargon and language that you have no earthly idea what it means. And instead of spending all day Googling, trying to find it out, and then trying to sort through what that still means once you find it, you can email your attorney and say, hey, I just got letter, form number, XYZ. Like, what does this mean for me? Do I need to be worried about it? And they might say, nope, shred it, you're good. Or, yep, bring that into us. We need to call them. They take care of that burden for you. I truly do think CPAs are well worth the money that they pay for. And they can also help you figure out what deductions are or are not going to be reasonable for you. If you take them a stack of them, they'll help you sort through, yep, we can do this one, nope, nope, yep, yep. So you can bring them more than you think you need and that they need, and they'll work with you on getting those deductions maximized. That's going to wrap us up for today's tax tip webinar. I did my best to sneak it in under half an hour. We are right at half an hour for you guys. I know no one likes thinking about taxes, but it is extremely important, and it can have a big impact on how you feel at the end of the year, depending on that tax bill. I actually don't have any questions. I'm gonna hang around here for a few more minutes here. Usually about 5 minutes is what I will hang on for everyone. Pop any questions in the chat box if you do have them if they do come to mind. If we can help you with getting that transition into an agency, if you haven't yet, please do call our office at 800-689-2800. Thanks, everybody.